Welcome, everyone. Welcome to another SaaS Connect 101. This is a pretty exciting topic. And we feel bad for Tomasz because we put you in the hot seat. It's the same as every VC panel at every conference. You can take it. So we have the deservedly famous Tomasz Tunguz and also equally famous Bob Moore. Tomasz is a managing director at Redpoint Ventures and a credible writer about how to analyze SaaS on all sorts of topics. And we have Bob Moore, CEO of Crossbeam here. And this is a conversation that a lot of us in partnerships worry about, is how do you convince the boardroom and VCs to take partnerships seriously and invest in it? Because we're always desperately trying to prove the value, what we're trying to do in order to grow what we think is a big opportunity. So just the format, folks, this is a webinar. We have a Q&A here in Zoom. Fire questions in that. I will try to fold it into the conversation. We only have 40 minutes for this. For those of us who are SaaS Connect members of the Cloud Software Association, we will have a separate speakers lounge afterwards, so you can chat with Bob and Tomasz directly after this on a non-recorded call. We gotta still stay human. So with that, I'll kick it off. So Bob, why don't you introduce yourself, because you represent us. So why don't you tell us a little bit about yourself and what Crossbeam is?
Yeah, I get to wear a few hats here just because of a few things I've seen before what I'm doing now, and then the nature of what I'm doing now. So just a little background on me. I actually started my career in venture. I worked at a firm called Insight Venture Partners in New York. That is a pretty prolific SaaS investor. I was super junior there, cold calling CEOs all day, trying to get revenue numbers out of them, kind of worked the very top of the pipeline there. And then left there to start my first company, which was called RJ Metrics back in 2008. RJ Metrics ended up being a big competitor of Looker, which is a company that Tomasz was on the board of, and that beat the pants off of us in a number of dimensions that maybe we'll get into later. And although we were able to navigate to a pretty good outcome, we were acquired by Magento, and RJ Metrics is now part of Adobe. And then I co-founded a business called Stitch, which is even nerdier than RJ Metrics, which was a data infrastructure business that was designed to help companies consolidate all of their SaaS data into data warehouses like Snowflake and Amazon Redshift. And that company was acquired by Talend in 2018. And at that point, I kind of took a step back and thought about the biggest problems and challenges and gaps that I had seen in all those different contexts. And the one that just kept coming up over and over again was kind of like this data standoff problem that we would run into whenever trying to work with any outside party. Trying to answer questions as simple as, how many customers do we have in common and who are they? Or are my sales reps currently selling to any of the same people that your sales reps are selling to? They were almost unanswerable because they involved drawing a Venn diagram between our data and our partners' data. And what Crossbeam was really envisioned to be was a solution to that problem, a platform that serves as almost like an escrow service for data that sits in between companies that are partnered with each other and allows both sides to connect data from their sales pipeline and their customer base and all their go-to-market systems, draw that Venn diagram, identify the overlaps, and collaborate in all the ways that they might, involving co-selling, cross-selling, co-marketing, et cetera, with what overlaps, but have confidence that the rest of the data is kept private and secure. So founded that business at the end of 2018. We launched in 2019, so we've been in market a little under 2 years. And we've got about 1,500 companies now actively using the platform. We recently raised a Series B from Redpoint, from one of Tomasz's partners, Logan Bartlett over there, who's now on our board. And really are trying to fight the good fight on bringing partnership technology into this modern SaaS 2.0 era, where it's not just CRUD systems where data gets loaded in through forms and you go back and look at it later. It's data being dynamically ingested and it actually telling you what to do next, and helping inform what the next best action is for all the contributors on your team. So happy to geek out about Crossbeam ad nauseum, but maybe the most relevant part here is we've raised a bunch of venture money and had to go to market and talk to VCs and convince them that partnerships as a category is worth investing in. And then we also have our own partner ecosystem, which we've recently started investing in pretty heavily. And we've had to go to our own board and say, hey, we should put some dollars, some wood behind the arrow on building out that ecosystem. So I've had to fight that fight on a few different dimensions along the way. And I think that's probably what we'll get into here today.
Yeah, hopefully. So Tomasz, you are well known, but why don't you tell us a little bit about your role at Redpoint, how you got there, and also like what Redpoint invests in to get set the table stakes of like how you look at the world and who you are investing in and why.
Yep, you bet. When I was 17, I started a company with my dad, and that was a SaaS company, and that's what got me into startups, and I loved it. And then went to college and grad school, and then I worked at another SaaS company that was not like a sort of a toy company. It was like a real business, 75 people. And that's a business called Appian that went public. And then I joined Google, and I was started answering customer support emails for my first year, and then became a product manager on the ads team. Stayed there for about 2 years, and then joined Redpoint as an associate, and have worked my way up, and now I'm a managing director. And at Redpoint, we invest anywhere from about 1 million to 40 million in companies, mostly in the US. And we're about 75% B2B, 25% B2C. And we're so basically a third software, a third infrastructure, and a third consumer. Actually, is a better way of looking at it. And we do a lot in infrastructure. So we're investors in Stripe and Twilio and HashiCorp, and we invest a lot in data. So we were investors in Looker and Snowflake and Dremio, and a bunch of other categories. And we've been looking at different companies with partnerships, and it's a topic. Maybe I'll just dive into it. I think when a startup, so I think there's two different ways in which we look at, or when we look at partnerships. The first time is when, as Bob was talking about before, a company comes to pitch and they say, hey, we're going to drive X% of ARR through a partnership. And then the second time is as a board member, which is when someone like Bob says, hey, I really want to staff a team of 3 in order to build out partnerships. And in my mind, I sort of break down partnerships into 2 different categories. One is like the ecosystem play, and the other is the big distribution deal. And I've lived through one of each. So at Looker, we were fortunate enough to have this great guy named Keenan, who was one of the first 10 employees. And from the beginning of the company, something like 10 to 15% of new bookings every quarter was coming through partnerships. And it was a very successful channel. And it was something that Lloyd, the founder, really wanted to develop and became really important for us. And then another company that I work with, we signed this massive distribution deal with a huge credit card company. And the idea was it was kind of not a bet the company deal, but it was a inflection point for the company. And we signed it in a way that made it gross margin negative for us to operate. But we said, hey, we'll trade the distribution for the gross profit. And in those situations, you're a minnow dealing with a whale, and it didn't turn out well. And so that's sort of like the mental model that we use. And then the other thing I'll just finish up with is our mindset when we look, and this is kind of our mindset when we look at a company that's pitching with a lot of partnerships, is you basically write the value of a partnership to 0 until it's producing. So if someone comes in and says, hey, we're just on the cusp of signing this great deal that's going to change everything, most of the time, you don't give it much credit. You might not give it any credit.
I brought props because I told you this. This magazine was sitting under my desk. I finally read it. So Tomasz Tunguz's SaaS Market Predictions 2019. Did 2020 work out the way you expected? No. You actually said Zoom. You were all Zoom in 2019. So
yeah, I have.
Nowhere in that article did you mention partnerships, but I think it would be helpful to understand what is important. Like, partnerships is a effective at the capital level, a tactical approach, perhaps. Like I think it would help for most of us who don't live in VC land to understand what is important to a VC when you're looking at a company on the macros. Like, what are you looking at? What are the most important ways of evaluating a SaaS company?
Yeah, I mean, at the highest level, if we're going to look at like 5 metrics of a business, one would be ARR growth. The second would be net dollar retention. The third would be sales efficiency. The fourth would be sales velocity. And then the fifth is pipeline to quota ratio. And all of those are basically just like answering the question of how much money do I need to put in order to get to a certain level of ARR? How quickly is the company going to increase its value? And how good is the product market fit? Like, that's basically what it boils down to. And then there are a whole bunch of like softer factors, right? How strong is the team? What is the founder market fit? Like, like, I mean, Bob's founder market fit is just exceptional, right? He's lived this problem many times and from a bunch of different dimensions. And so there's no one better to start Crossbeam than Bob. So that's a really important distinction. And then the last sort of high level consideration is, if the company works, what's the size? And that's the one, how big can it be? And that's the one that we consistently get wrong. Because you're trying to predict the future of, like, who would have thought that like Twilio would be a $20 billion company or Shopify a $100 billion company, when we met them at the A. Like, could not have predicted it. So that's the like at a high level, at the highest level, how we look at companies.
When you look at these prospective investments, I know one of the neat things about Redpoint is that because of the growth fund and the ability to write even smaller checks, you can get in at this seed, you can get in at the A, you can get in at the B, or even later. How do those answers change maybe as it relates to where you do give some credit for partnership programs at those different stages? Like, what it sounds like anything in a seed deck that involves the word partnerships is probably just getting written off, right? So when is there enough scale or momentum that it starts to actually be a needle mover in the investment decision?
It's a good question. I think it's going to depend on the category. So at the early stage, what you really want to see is that a company is not isolated, that it is part of an ecosystem, whether or not that ecosystem is producing revenue or new bookings for you. It's kind of scary to be on a board of a company that's operating in complete isolation and isn't talking about the companies and the competitors that it's adjacent, because it suggests that either one, the market is smaller, and it's small because it's unattractive, because there's literally nobody else in there. And so, like, I think it's probably at the Series B or the Series C that you typically see most companies, like the partnership's contribution to new bookings is large enough to be not even a separate line item, but to be talked about as a slide.
Mm-hmm. Yeah. One of the things that I think we've been seeing more and more, I'm curious to get your take on if this is credible or if it's just, hand waving, but we've seen companies folding ecosystem influence and partner influence into their attribution models. So when you have a multi-touch attribution on a new deal, right, you might say, oh, they read a blog post and they also clicked a Google ad and an SDR talked to them 3 months ago. And you can start to develop some of these models where you say, the SDR touch was present in X number of deals, or it contributed proportionally this amount of revenue. When you fold in data from the ecosystem, whether you get it out of something like Crossbeam or you email a bunch of spreadsheets around and do account mapping or whatever else, another form of touch that you can have in there is, they connected this technology integration, right, which hooked our product into this partner's product, or there was this particular channel partner that we have that had some touch along the way. Even if they didn't refer the deal, it was in their ecosystem where they consume their partner content. As the visibility into that data gets greater, how much do you think it's credible or valid to tell the story of these partner touches as being kind of an indirect influence or a contributor to the revenue story on that bigger revenue number, instead of just the purely sourced partner stuff?
I think it's really important, because the change that has to happen within these companies is management teams and boards have to start looking at the partnerships team not as sort of an entirely separate customer acquisition vehicle, more as like part of a broader team. It's like, Nick Mehta with his like Gainsight customer success thing, like everybody's involved in customer success, right? Everybody's involved in selling. And sort of the mental model that a lot of boards have today is like, we've got our marketing or sales-led go-to-market here. And then here's this other thing that may or may not work, which is in partnerships. And that's a completely separate can of worms. And let's see what happens. But I think the more that you can synthesize those in a really effective way, I think the better for the partnerships team, and ultimately the better for the business, because what you have to do in order to, drive a lot of businesses, educate those channel partners in those ecosystem really well. And so the more they're working together and having success, the more success they will have.
That's great. Maybe it might be interesting to double click on Looker a little bit through that lens. So, in those early days when Keenan was driving 10 to 15% of revenue through partnerships, I know at least late in the game, technology partners were a really big deal. I know even at Stitch, I'd say probably, a meaningful double-digit percentage of Stitch's sales pipeline was always coming in through Looker, and we were referring them deals all the time. When you think about that foundational program that Keenan built, was it really heavy on the channel and the agencies and the resellers, or was it really heavy on the technology partners and things that were less kind of in just being an outsourced sales engine and more so being a product partner?
Yeah, for sure. Actually, Steve just asked exactly this question, so it's awesome that we hit them both at the same time. So yeah, so awesome. So in the beginning, as I recall it, in the beginning, so you would sign up for Looker, you would need to configure it. You would need to write a bunch of LookML, which was something specific to us. And we would get you on a jumpstart call where for 30 minutes, we would configure it with you, and then you would go and configure it yourself. And we got to a point where there were so many jumpstart calls that we didn't want to do them in-house anymore. And so we went to like agencies like Slalom and a bunch of others who are in the data world, because we said, hey, here's the line of new business for you that we could offer you that we don't want on our books, but you would love to have it. And so that was, that was definitely very, very early on. Like I want to say like 9 months after the Series A, something like that, we were talking about that. And then, which is unusual, right? Like it's not.
Yeah, especially with folks like Slalom, which is like they're so huge, and you think about who they work with, and it's typically not Series A funded startups. Like what was the magic in the bottle there?
Oh, well, they were smaller back then. They were sort of a mid-market boutique consultancy, and we could drive enough predictable business for them that it started. You get one MD interested, and yeah. And then at the same time, we were the technology partnerships, and this is what Steve is asking about. They were super important to us. So we went to first it was BigQuery, and then it was Snowflake, and we became the BI system that both of those databases used to demo their databases.
Oh wow!
And so what ended up happening is, anytime a Snowflake AE or a BigQuery AE was demoing them, they were also demoing Looker, and the buyer would always say, I just want the whole thing.
Mm-hmm. That's incredible. Yeah.
One of the interesting things about this conversation is this mismatch, which is fair because there's a translation that's going to happen at different levels of the company, where we were talking about, to summarize, dollars in equals dollars out at the VC level. That's basically what you're looking for, is like how much dollars in to get dollars out, if I read you correctly. But partnerships is not driven primarily from a dollars in dollars out model, because it's not sales, it's a partnership, and you're actually trying to drive sales for the partner and get dragged along into their sale, and it's more of a marketing approach. And what it sounded like was at these companies is that beneath the level of C or below, someone inside the company had gone off and done partnerships, and they had reported and translated their results somehow into things that make sense for the board. But that you were kind of lucky in some ways that they had hired those people and they did it without the blessing, perhaps, of VCs. Is that what happened?
Yeah, so in every board deck, there was a slide that Keenan would go through, which was, this is the partnership source pipeline. And he made it look like a sales, this is the pipeline, and this is the bookings, and this is the fraction of the bookings associated with, and then here are all the different partners that we're working with, and here's who's on deck. And, he would present it as, hey, we're working with 10 partners this quarter and 12 partners this quarter and 15 next quarter. And we would look at the distribution of activity by each individual partner, like you would look at leads from like Google versus Facebook or something.
And was he hired? Like, was he just doing that? Did he start doing that partnership stuff before he started reporting to the board, or was he specifically brought in like a board level conversation? That's, I think, the interesting thing a lot of people face is a lot of times partnership just happens because the CEO wants it to happen or product wants it to happen, right? And then they ends up coming up to the top. But sometimes you have to go up to the top. Like we had a talk with Brian Jamber from Sendoso, who literally went up to the board to get the investment for his partnership team before he went into it. That's another conversation. So I think that's like, what's been your experience? Is it happening first and then they come up to the board, or board and down, or both? Like, what's happening?
So Keenan was unusual in that he was part of the board meeting day one, right?
Okay.
And so it was just like, at least as I mean, this is a long time ago, it's 5 or 6 years ago, but that's sort of that's how I remember it. Most companies, so the advice that most board members give to companies is don't engage in partnerships until you reach 10 million in ARR as a rule of thumb. And the reason is you need to drive enough business yourself to convince a partner that you can drive enough business for them. And the rule of thumb is if you can drive 500,000 in new ACV or new bookings or whatever for a partner, then it's worth spending. And then you have either the board pushing for partnerships and saying, hey, we should hire somebody to manage this, or the exec team pushing for it. The other catalyst for emphasizing it is if you view your competitors partnering with others in ways that change the competitive dynamics, then it becomes a higher priority too.
Very interesting. So like Bob, this goes back to your story. And this is like another point that you guys have touched in your history. So you have this really famous, I love it, blog post about your experience at RJ Metrics versus Looker. And at the beginning of RJ Metrics, my impression was that you were much more driven by your own short-term, like pull by your nose sales numbers at RJ Metrics, and only too late realized that the ecosystem strategy was critical. And then Looker ended up winning in that market. That's basically the crux of that article. It's a great article. So what happened in RJ Metrics? What was your story?
Yeah, and I think there's kind of two pieces there. One of them is just that I think we by launching in 2008, when SaaS wasn't even called SaaS yet, or it barely was, the moniker that had been picked up. This idea of offering any kind of analytics via an application service provider or via a web delivered system was strange, and even AWS was in its early days. Redshift didn't exist yet. A lot of what has become the modern data stack did not exist, and the pain point in and around analytics was actually that it was very, very hard to piece together the components needed to have the complete life cycle of a data point, extracting it from various systems, talking to APIs, housing it somewhere in what would later be called a data warehouse, but really was a database back at that time. And then creating a presentation layer on top where you could look at charts and dashboards and model the data. The individual components had not really been broken apart. And our innovation at RJ Metrics was that we just built this big monolithic platform where we built all of that stuff. So the product vision was pretty vast because we had ETL, which is like the data pipelines, extract, transform, load. We had a data warehouse, which was basically white labeled MySQL instances that were running on Amazon Web Services. And then we had what you see if you go to our website or take a sales demo, which is our charts and our dashboards and our front end. But because we had built this big monolithic thing, we were the entire ecosystem in one product. And we were kind of where your data went to die, because it entered in through things that we built. It was processed through things we built. It was visualized using things that we built. You consumed it using your eyeballs and maybe exporting like a CSV and opening it in Excel. But the data didn't really have anywhere to go after that point, because we were downstream enough at our endpoint that there weren't any more consumers there. And what ended up happening was in the early 2010s, the rise of these cloud data warehouses started to happen, first with Redshift, which quickly became AWS's fastest growing product in history. And it basically drove a giant wedge right in the middle of that stack. So we used to do data pipelines, data warehouse, visualization, and we did all three. Now there's a better version of data warehouses that gets wedged right in the middle. And it basically meant that if someone wanted to use Amazon Redshift, this hugely popular, very performant, very affordable data warehouse product, it meant that using RJ Metrics didn't make any sense anymore, because we may do store the data in our universe. So we had these major architectural hurdles to overcome around how do we incorporate the benefits of these modern cloud warehouses. Meanwhile, it created this amazing market opportunity for businesses like Looker to basically partner up with the other participants in that stack and co-sell and go to market together, being a best of breed for each of those individual components. And it took a lot of the ownership of the purchasing responsibility out of the hands of the marketing teams and into the hands of the data ops teams and the infrastructure teams, changed the personas, and drastically increased the amount of spending that was available. And I think while we were chasing our tail, trying to either adapt or pivot our way into markets that would be receptive, we still didn't really have any partners. And I think Looker found a ton of success in exactly what Tomasz described, which is that if you were buying Redshift, you were buying Looker, or more specifically, BigQuery and Snowflake, I think were the real key partners there. Just because it was usually the main reason you wanted to have one of those platforms in the first place. So, I think it was ignoring an ecosystem strategy as part of the vision from day one failed us in being able to see where the puck was going, and then left us on an island. And look, we ended up with e-commerce as a vertical that we just, we did great in e-commerce because they tend to not have data ops teams, especially mid-market ones. There's a lot of third-party agencies that do the development. But we watched our TAM shrink on the verticals dimension because we really got narrowed down to just e-commerce. And then we watched the TAM shrink on the company scale dimension because as those e-commerce companies got bigger and bigger, the more likely they were to have in-house data ops and then also move off. So, we got pigeonholed. And I think,
yeah, I mean, that's,
Looker had the opposite.
I mean, that's a story. If you eat the whole pizza, you can't have a pizza party. That's the partnerships. Well, I like it.
We ate the whole pizza and it wasn't even a good pizza. That was.
I mean, I'm Canadian. I hope it was Hawaiian. But anyway, that's a whole debate up here. Here's the thing. My view, obviously, because I run the trade association, but also my own experience of the career is that these ecosystem strategy companies, have over the last 100 years won every market they're in. You cannot win a market. You don't have TAM if you don't have an ecosystem strategy. There has not been a single company that has given up the ecosystem strategy or the distribution strategy to another player and won it. That's the other player who wins. Coca-Cola is Coca-Cola, not just because it has nice soft drink, because they own every single distribution of every atom in this plant. They can send an atom anywhere on this planet if they feel like it, and they can do it. That's why they win. Pepsi can only compete with them because they built an equivalent distribution nationally in the United States, and they don't win globally. Microsoft wins because they have distribution across the whole planet, right? Right. So that's the question I have. And Tomasz, when you look at this dollars in, dollars out ARR story, which is annual recurring revenue, that's like that short-term time horizon. Versus like Bill Gates when he took the smackdown to Mark Zuckerberg. He said Facebook is not a platform because you're not building other people's businesses based on it. That's what he said. Like a Microsoft partner makes $9 for every dollar that Microsoft makes. So they have $1 trillion ecosystem. They're 1% of the world's economy. They are the biggest B2B SaaS player right now. They beat Salesforce 2 years ago because they brought their channel to bear. That's the kind of thing I'm interested in, as a career path for partnerships. 10% of revenue is actually low. It should be, Jay McBain says, closer to 50% in a mature industry. That's kind of where we're at right now. So I put it to you, when these stories come out, how do you wrap your head around that? When you're looking apples to apples, the VC land.
I mean, Microsoft's story is really powerful also because of its ability to compete with Slack, right? And that's all channel driven. Within a year they catch up. So it is really powerful, and I think there need to be more success stories before VCs are willing to invest in a channel-led business. Maybe the more recent sort of success story is the Databricks Microsoft story, where Microsoft contributed a significant amount of bookings, even at the Series C, and it was a pretty strategic partnership. But that was more of a whale hunting partnership as opposed to an ecosystem partnership.
Marty Armstrong has a good comment actually on this dimension, if I could summarize it. So Marty says, other key areas beyond sales lead we've evaluated tech partnerships have been distribution opportunities. That's sure, net new sales, great. Fills a product gap, supplements a feature, function, value prop. That's part of the sales option, fills out your ability to sell, improving cost or complexity barriers of entry for a customer, impacting TTM and TCO. So that's, again, impacting another subdriver of a business metric. That's where often partners go in, they help you address an underlying metric. These are good, that's a good comment, because that's another way of evaluating partnerships on a metrics level, because every partnership has an underlying core business metric that it's tied to, of course, because it's a partner, right? It's going to drive a core business
totally.
Metric. Karen asks, maybe this is good for you, Bob. How do you evaluate the value of partners? And do you consider partner loyalty? And how do you measure it, basically? It's from Karen Hartzell, sorry.
Yeah, I think there's Tomasz mentioned earlier that one of the most important SaaS metrics is net dollar retention. This is like net dollar retention for partners, right? Like all the reasons that churn is bad. It costs so much more to get a new customer than to service an existing one or grow an existing one. And, the pain associated with that, that going away. It's true for partners too. I mean, the upfront analysis of whether to evaluate a partnership, the ability to actually execute on that partnership in a scalable way. These things you get some economies of scale when it's going really well, and when you can throw more resources at execution instead of the initial configuration. So partner loyalty, falls under that same exact lens as customer value. And that means that proportional, if not disproportionate, investment should go into partner success as goes into partner origination. And a lot of that, again, comes back to what is the technology that you're putting in place to basically make those motions you're going through with your partners repeatable and scalable and measurable. What are the things that are going to let you tell the story of partner success internally such that you get the resources you need to make those investments? Because if the most dangerous KPI that board can throw down to a head of partnerships is how many partners do you have? Like my guess would be that if Looker shed every single one of those partners except for Snowflake and BigQuery, they probably would have been all right. Right? There's a major like power law rule in effect with these things, especially when you get into some of these ecosystem plays where it really, really starts to be material. For those $1 trillion worth of economic activity tied to that Microsoft ecosystem, Microsoft probably has a pretty good distribution, but all those Microsoft partners sure don't. You know who their number one partner is? It's Microsoft. And I think that like the nurturing of the people that are at the head of that power law curve, should probably, the energy you spend on cultivating those should be proportional to how big their potential impact is. And I think that's, the dimension to measure it on is really almost like a cohort analysis of your partners, when they came in, what their contribution is to whatever the KPIs are that you're looking at, and give them time to mature, but make sure you're looking at them apples to apples and cohorting them and tracking it in that way.
I'll just throw it back to you because we're not going to this is an interesting point. This is the point where these conversations have met in the mark, like we're at right now, the status quo of it. And there's parts where it doesn't logically make sense and connect. So let me give you the counter example based on this conversation. So Twilio, who would have thought they would get to $1 billion of revenue? Do you know, like most of their partners are just like shops, they're just like coding, like they have so many, that's how they won. Like they were a developer friendly company from day one.
Yeah.
Right.
Well,
these companies are not like going to be like, eventually they got Accentures and all that stuff, but they got there by winning an ecosystem strategy from day one. Right.
Yeah.
So how do you put that into the mix?
Maybe the greatest curse on our industry of partnerships is the fact that technology partnerships and channel partnerships are under the same umbrella when we have these conversations, because it is so, and this is a distinction, like, I don't know at what point in time, and maybe, we can throw Nick Mehta some credit here or something else, when customer success forked off into its own entity that had its own set of discussions around it and its own vernacular and its own KPIs. When really account management used to just be a designation that sat underneath the sales team, and account managers were sales reps wearing a slightly different hat. There's a very similar thing going on right now. And I think it's fundamentally changed in the last 5 years with the maturity of the API economy, where these ecosystem plays and the role of technology partner programs, not just on contribution to ARR, but on the core product and go-to-market vision that underlies a lot of emerging companies right now. It's different. It's so different than when we talk about, the Microsoft example is a true like channel example. Any case where you have a high volume, like a long tail of these agencies and reseller partners. We saw this at Magento, right? At 10,000 global system integrator partners that were out there building Magento shops. Huge percentage of the go-to-market dollars. That was not a technology partner program. And I think the fact that and the App Store ecosystem / the core technology integrations that existed there kind of all got lumped into the same thing, forced the conversation to get muddled. And what I think we need to do, going back to your Twilio example, is like really ask the question, okay, great. There's a lot of really good reasons why a traditional channel play makes a lot of sense for Twilio, because they enable so much that is makes other technology products and the implementations of those products so much more valuable. System integrators should be gobbling up and reselling and implementing Twilio all day long. But they also have a really tremendous story around building out a technology ecosystem and making their core product embedded into other offerings, so people never need to even worry about using those system integrators in the first place. The two actually are forces that work against each other. If you're using a really strong tech integration, the chances you need the SI are probably lower. And yet we're talking about them like they're the same thing. And they're actually like polar opposites in this universe of third parties getting your product out to market. And the more we can bifurcate them and have those conversations separately, I think the more constructive the conversation can be.
That's absolutely right. Because in their case, it was when we think about partners, it actually you're not thinking far enough. You're not looking far enough. The customer is driving those things. The customer needed a developer, so they had to work with developer evangelists. Customer has tools, so they're working with the tech things that the customer is driving it. Just happened to be in their case. That's the shape of the market they were in. That's a good point. We're coming to time here before we go to Speakers Lounge. And if, by the way, if anyone who hasn't joined, you can come. They're in our Slack. I put the link in our Slack to how to join. But this has been an interesting conversation. We weren't going to solve everything, but hopefully we learned something. Any last takeaways? What did you learn from this conversation that might have changed your model going forward? Tomasz, I'll throw it to you.
Yeah, I think I'm going to be more open when hearing pitches about building ecosystems. As Bob was talking, I was thinking through a handful of different companies that are operating within, trying to disrupt industries that have historically been channel dominated. And that's probably where we see a lot of the channel activity. So I think about physical security is completely dominated, right? Even internet security actually has a fair amount of channel business. And so I think there's a greater sort of inclination to do it, but that's very much sort of a classical way of thinking about channel, where there's this new model that, in the warm up to this, and then the previous session that we talked about, what we're going to talk about, Bob really mentioned this idea of building ecosystems, and that's something I'm going to think a lot about, because I think it's absolutely right, and I'm going to look at partnerships, teams in a different way when I think about ecosystems.
You should invest in Bob again. I'm just kidding.
Yeah.
Bob, how about you? What did you take away? What did you learn from this conversation?
Yeah, I think it's a really great reminder how, we can, and I think that the CSA for the most part is dominated by people that are on the technology partnership side. So I think it's easy for us to kind of get sucked into our universe of this ecosystem building and tech integrations and connectivity. But you got to remember the money's in the channel still. The market cap created by the generation of these ecosystems is pretty damn substantial, but the attribution that you can assign back to those ecosystems is a little bit more hand wavy than being able to say, last quarter, 40% of our new revenue came in through our channel sellers. And I think we as a community have a responsibility to think about the way in which we present and storytell ecosystem building and the equity value it contributes to these companies that it helps form, and figure out what the frameworks are and what the storytelling is going to be, so we can do for our universe what has been done for customer success, and kind of make that its own defined, carved out category with the KPIs and the people and the job titles and the success that's attributable. So I think it's when you're talking to VCs and you say partnerships, and you think dollars, you think channel still. And I think that's going to be that way for a while. There's a lot of uphill battle ahead of us to kind of buck that or to be distinguished from that.
Yeah, and for me, the takeaway is to tie those things together. Is the word partnership is the wrong word, because it immediately generates risk and confusion because you don't know what it means, right? But there's always the core metric of the business, and every potential partner is actually driven by the customer. And so I think for the CSA, what we can be doing is trying to help our members break down what these partners are, but from the customer side, provide metrics about their behavior from the customer through the partner to the company, and then tie it to the core metric that is actually what it's going to be reported at the board, whether it's demand or conversions or retention or, pipeline, whatever it is, there's a core metric these partners have to be touching. And then it all makes sense, right? Because it's driven from the customer. All right, everyone, thank you very much. We've recorded this. We'll post it as soon as we can onto YouTube. And for those of us who are members, SaaS Connect members, thank you. I'll post the link and hash members in the CSA Slack. If you're not in the CSA Slack, cloudsoftwareassociation.com/join, come join us. We do this stuff all the time, and it's important conversations to be had. Thank you very much, Tomasz, Bob. Thank you very much.
Thank you.
For more great insights on partnerships and software, like, and subscribe, and we'll see you in the next video.